What's going on, Wes?
Good.
How are you?
Doing pretty well.
Welcome.
It was a good
Welcome.
day.
All right, so we're here with Wesley Graham, Cross Country Mortgage. They are our partners. We did a podcast, probably like one of like the third or fourth ones ever that we ever did was with you. But now we're back because the market has shifted. Everyone is a keyboard warrior, knows exactly what's going on.
I don't know if the market's shifted so much for housing.
It's
same pace as last year.
But and inventory is shrinking.
Yeah.
So it's not, it's like, I mean, if you're inside these four walls, it looks the same. If you're outside the four walls, everything's,
The economy's shifting.
Yeah, that's for sure.
There's definitely, a lot changing there. A lot of buzzwords, inflation,
stagflation,
recession.
So let's dive into it. Let's kind of unbox just generally hit us with like general inflation knowledge.
Yeah, so inflation, there's kind of two ways you can really think of inflation, and they kind of account to the same thing. One is the dollar's worth less. So for any currency, if it's inflating, then essentially its buying power is decreasing. So on one hand, inflation means, hey, for every dollar, you can afford fewer goods.
Mm-hmm.
On the other hand, it's also the prices of goods are increasing.
Right.
And so sometimes you've got causes for different things in a broad sense, and you have both of those things are really conflating right now. And, the Fed printed a lot of money for us to get out of COVID.
Well, so let's kind of address that. So that's kind of how it happens. So if you have $100 and it's all backed by, however you want to call it, it's backed, $100, each dollar's worth a dollar.
Full faith and tax paying or the taxing authority of the federal government.
Right. So you have $100, each dollar in that 100 is worth $1. Then we're just like, we need more dollars. Let's make more dollars. They're not all now worth a dollar still. That's kind of what we're leaning to, is that as you print more money, the existing currency decreases in value because there's more of it.
Yeah. And, in the past, America was on a gold standard. Now we're not backed by a gold standard, right? So now all we're backed by is the ability for the federal government to pay its bills. And so, and ultimately the bonds.
How are we doing on that?
We're the cleanest dirty shirt is how I would put that.
Love that.
But so, inflation's a normal thing.
Right.
Inflation naturally is part of a growing economy. Yeah, and normally 2% inflation is actually the target for the Fed. And, that's to accommodate increasing liquidity to the economy, allowing businesses to invest and hire more employees, all the good stuff, right?
Right.
And, when you get high inflation, you get over that target. That's what we're talking about now. And certainly, we're well above that target now. But it's not just a matter of, what the Fed does. That's the monetary policy side. And so, again, the Fed trying to help us through COVID, did kind of quantitative easing. They expanded their balance sheet and, in doing so, they printed money, essentially. I mean, for lack of a better word. By one measure, M2 is a measure of the monetary supply. We've expanded our monetary supply 40% in the last basically 18 months. So in a vacuum, that means that your dollar is worth, the inverse less.
Right.
Right. So the other piece of inflation, though, that's also important to factor in, and this is a lot of what Jerome Powell had been saying last year, was he right, wrong, hard to say, but you also have just goods cost more.
Right, just right, exactly.
Right, and so the supply chain and a lot of the stuff that also happened as a result of COVID is another huge piece of that equation. You've got what's going on in oil and gas, what's going on in which really spills over into everything, right?
Right.
To ship everything's gonna be more expensive if diesel costs go up, right?
Right.
But in turn, lumber prices, everything else that you saw happening through COVID, that's a whole other part of what's going on. So you really have this big conflation of those two things butting heads right now. And, the Fed last year kept saying, oh, well, this is temporary, and it's because of the supply chain, and that's going to open up, and we're going to be fine. And, what we're now starting to realize in a somewhat abrupt fashion is maybe not.
Right.
And
that's what everybody kind of spins out when they hear inflation. They also kind of think recession. So, I mean, everyone keeps talking about we're going into a recession, we're going into a recession, we're going into a recession. You kind of have a different stance on that, or I don't know if it's you or just generally, like people are just like, we're going into a recession.
Well, I think it's important to understand what a recession actually is. And, at the end of the day, a recession is 2 quarters of economic contraction.
Right.
Right. As of today, they released today, last quarter quarter one of 2022 was contracted 1.4%. And so what that means is year over year, that quarter actually did see a decrease in overall economic production for the United States economy. 2 quarters of that so this quarter is the same, then technically speaking, we're in a recession. Now, sure as heck didn't feel like a recession in North Florida last year, right? Especially by the measure that people have anchored themselves to logically. You look at the Great Recession.
Right, which is everybody, that's what everybody weighs it to because,
and there's a very, and we'll talk about this, a bunch of the topics we want to talk about today, it's going to come up over and over again. People like to anchor their logic, right or wrong, to recent events more so than looking at the overall factors. And so, the Great Recession was anomalous, as far as recessions are concerned. Recessions are a normal piece of the United States economy. It's a cyclical environment.
Right.
It's a normal part of any economy. It doesn't necessarily mean the catastrophe that was.
Right. And I think that's what everybody, just like you're saying, they're anchoring in things that they're familiar with. Everybody kept, I remember in 2006, 7, and 8, everybody kept talking about 1920s and all this stuff, but really a lot of those people weren't even around then. Now, because it's such a short distance, I would say short distance, a lot of the people now then, I was in 2007 and 2008, I was still in high school, so I remember it, but it didn't affect me the same way it would have affected somebody who's my age now.
Right.
And I think now people are spinning out of control, I remember everybody was just flipping out then. It's yeah, but if you aren't seeing anything outrageous happening in your life, all of a sudden it's not just going to drop the bomb. You're not going to be worth anything.
Right.
But if you're living beyond your means or purchasing something you very clearly shouldn't be,
different story.
Right.
Right.
In any economy, it's just
doesn't
not
really
a good
matter,
idea.
right? Foreclosures happen in any economy.
Right.
Do foreclosures happen at an unprecedented pace? Does the entire financial system implode simultaneously? Does all capital freeze throughout the economy, at least temporarily?
Right.
That's not the norm for recessions in American history, which made the Great Recession, Great Depression analog, a pretty good one.
Right.
And so at the time, that ultimately was kind of the closest comparison. It wasn't necessarily akin to the recessions of, the 80s, the dot-com bubble, which, the different economic cycles we had that ultimately recessions lead to higher unemployment. They lead to, a wide variety of suffering.
Right,
economy,
yeah, of course.
For sure.
Yeah.
But the Great Recession, certainly was attached to some different dynamics. And, a few of those a little bit different today.
Right. So let's walk our way back. We talked about the dollar, inflation, all this stuff. How is this kind of aligning itself with crypto, NFTs, things like that, to where the digital space, where it's kind of like they go hand in hand, obviously, with, that Bitcoin has a finite amount that there are. So let's kind of talk about and bridge the gap, because I feel like a lot of people have questions on is crypto the best buy, a safe buy? What is it compared to the dollar? How does that work? How does that look? What does that look like, et cetera?
I think that crypto, and it's important too not to distinguish everything in the crypto space, to consider everything the same. Personally, and everyone has their own opinions. Personally, to me, I feel like Bitcoin exists on something of a pedestal in my mind, because there is truly a finite number of Bitcoins.
Right.
And there are some cryptocurrencies for which that's not the case. And there could theoretically be, you could run into the same problems you do with the dollar. Although, it's all within the blockchain, it's a little bit different. But so, with Bitcoin, there's a finite number of Bitcoins, and obviously the more complex the chain gets, the longer the chain gets, the more complex and powerful the computing power needs to be.
Right. Which again, to address that, we're talking about how the Fed just printed money because we needed more money in circulation. You can't just make more Bitcoins.
Right.
Once all the Bitcoins have been mined, they're done. That's it.
Yeah. And I think that, in and of itself, that does establish a value. You might perceive that establishes a value in any kind of currency, right? When America used to be on the gold standard, we were backed by gold. We left that in the 70s. And really that, one could argue, has allowed us to go into this more dramatic boom-bust cycle. And so nonetheless, I just think that, where Bitcoin in particular occupies a a space in people's minds is it is a finite thing.
Right.
It is outside of the whim of any federal bank for any country, so it should exist outside of the political spectrum. Conversely, though, how people decide to regulate it and what consequences are there provides a degree of risk.
Right. And risk. So it's funny that you mentioned risk, because risk is basically what is the difference between 2006, 7, and 8 and now when it comes to issuing loans and betting and crypto, et cetera. It's like if you're buying into crypto, the risk of buying crypto is it's either going to completely fail or it won't, which you're kind of saying there's a safe bet in the fact that there's a finite amount. So realistically, like once it's done, it could only go up. We can't make more of it to dilute the amount there is, like the dollar, to where now the dollar value is falling. When it talks about risk of buying something like that, where does the risk lie in purchasing a currency that's not really backed by anything?
Well, and any currency, so the U.S. dollar, right? It is backed by the taxing authority, essentially, of the U.S. government, right? I mean, so that's how the government pays its bills. So if the United States economy collapses and there's no tax revenue to pay those debts, and you default, then theoretically the underlying revenue structure that supports that currency disappears, and poof, it goes bust, right? I mean, that's ultimately what you're talking about,
right?
Or you get a Germany 1930 situation where 20s and 30s. You print money excessively, or Zimbabwe just recently, Venezuela now. You print money excessively to try to solve a problem where it just completely becomes unhinged in relation to the ability to ever repay those promises. Essentially, is what a dollar is, and so you get hyperinflation, which is catastrophic. I mean,
yeah.
You've seen the pictures. People with wheelbarrows of cash to go buy a loaf of bread. I mean,
right.
It's that happened.
That's insane.
Yeah, and I think that again is where I think crypto is attractive to a lot of investors, in that they see those images and they go, well, that could never happen to this.
Right, and that's why I wanted to kind of like throw in the air, is because that's what a lot of people think, and hearing it from somebody with obviously an economics background who's more than qualified to actually discuss that, because half the time, right, it's just people like myself just like kicking around like, yeah, I heard on Twitter, you hear this, right? So it doesn't, people just try and put things together in their head that make sense, not necessarily that they're true.
Well, and my concern though, and it kind of goes along these lines about crypto, is it still isn't backed by. That's
my point, is that you're saying that the U.S. dollar is backed by the taxable kind of.
It's a promise.
Yeah, that's what I'm saying. It's not really backed by anything, and I think that's what people are worried about, is that it's just farcical. No one can control it, which means it's just like as soon as everybody just dubs like, I don't want this, it's going to lose its value.
Right.
But I think what people don't understand, which is kind of what you're saying, is the fact that as long as people are accepting it to do things and it has value, it will keep value.
Right.
And it's not really manipulated by any sort of geopolitical, like, oh, well, they printed so much money now, like the Bitcoin is worth nothing, right? It's not.
Well, but the other side of that argument, though, the double edge of that sword, is that at the end of the day, Bitcoin's value is ultimately denominated in global currency.
Right.
And so, Bitcoin being a hedge against global currency implosion, well, if every currency implodes, if we have a crazy catastrophe economically, globally, without some underlying value to Bitcoin itself.
Right.
I mean, infinity times zero is zero.
Yeah.
Yeah.
So
I think
that is true. That is true.
Math guys.
That is true.
But so to me, it's like, if I think as a temporary inflation hedge,
right,
barring the utterly catastrophic, I do think there's an interesting space that it occupies.
Mm-hmm.
But as a hedge against total catastrophe, it's like, well, you're kind of in the same boat as everybody else at that point. Like,
right.
And I think it's interesting too, and kind of getting to the risk question.
Yeah.
Is Bitcoin intrinsically valuable, or is it a risk asset, that people are speculatively investing in?
Right.
When interest rates are high, you generally get what we call risk off in the investment world, which is, if you can get good yields on what's considered to be a traditionally conservative investment, like bonds, you can get good yields on, if you were to buy, commodities companies, right? Steel companies, oil companies, utility companies. When you reach these kind of recessionary cycles where the economy's suffering, generally the investments that are considered to be more conservative outperform, right? Because people have to eat. They need a house, which we'll get to. They need electricity, all those kind of basic essential needs, they outperform. They're counter-cyclical. Whereas speculative assets, tech assets, I would argue Bitcoin. I would argue, certainly NFTs. The Rolex market right now.
Yeah, the luxury
guys.
I was going to say the luxury watch market right now is fully bananas. I actually said this to.
It's stainless steel.
Yeah,
it's steel. The tech is.
Yeah. Well, I said this to my family as like a joke. I was like, guys, the luxury, because we like cashed out of something, and I was like, we should all buy Rolexes or something, and everybody's like, that's the dumbest thing ever. I'm like, if you purchased that same watch 2 years ago and then you have it now, I'm like, it's almost up.
But if you purchased it 2 years ago, the techs are starting to fall.
Yeah,
and Rolex hasn't yet. But so what you get, and when you have incredibly low interest rates for an extremely long period of time, and then you get dramatically excessive monetary support, which is what the Fed ultimately did to get us, out of COVID. I would argue that, what they initially did as the economy was in free fall probably made sense. What they did when the economy was recovering and they continued to stimulate the economy, and they still continue to stimulate the economy in different ways as we speak, despite the fact that we have 8.4% inflation last month.
Right.
Not great.
Not great.
That was probably excessive. And so when you get that environment where there's excess liquidity, excess cash flushed into the system, you're going to get this speculative investment cycle where people do dump money into things. When rates start to climb, and this is ultimately why the Fed raises rates. When you get that overheat in the economy, the Fed finds itself in a position of, okay, this is unsustainable.
We need to stop spending.
We don't want to look like Germany, in the Weimar Republic. And so, they get the reins on it and they start to lower, raise interest rates in order to cool things off. And so the first assets you see that tend to underperform are those speculative assets. And so an interesting thing in Bitcoin, and it's been a bit all over the map lately. I mean, it's been volatile like everything else. But you initially saw a big risk off. So we call a risk off, right? I mean, so as rates rise, people get a little more worried about the economy. It's those kind of speculative investments that initially start to lose value. And Bitcoin fell in with that.
It definitely.
Since then, but the fact that as inflation's continued and as rates have continued to rise, the fact that it seems to have stabilized while you see, NASDAQ was down.
It's kind of like,
ago.
You think it's the bottom line has kind of adjusted to like where?
I don't know. I don't know, but it's an interesting question. If you're arguing that it's an inflation hedge, and when rates go up, it loses value. It kind of is. Well, what is it really? And again, I don't know. I mean, I think it's still something that
Well, let's pit it against something. So obviously, we'll call it risk. All right, you're purchasing anything. People then look at current housing and they say it's a risk because they see just this crazy inflated home prices, all this thing, the competition. And housing has always been the most sure investment.
Almost always.
Almost always. And I think people are getting this all like mixed together and don't really know how to kind of compartmentalize it. So let's break down like why this housing crisis is not related to the prior.
Well, and I wouldn't say it's entirely not related, but I think the way to think of risk is again, I think a sensible place to frame it. Housing in general is considered to be an inflation hedge. Okay, and the reason for that is same reason why oil stocks do well in an inflation environment. Same reason why people tend to buy less risky assets when the sky seems like it's falling.
But people need gas, people need homes, people need things.
You have to have a place to sleep, right? And the big thing about housing in this environment that we're in now, it's become an incredibly finite resource. And so I think kind of back to the Bitcoin thing, and again, we're to me the jury's out on what exactly Bitcoin winds up representing, insofar as a secure stable investment.
Sure.
But the thing about housing is, in normal times, you can't snap your fingers and suddenly, you can't build more land, right? I mean, that's the old saying, right?
Right.
You can't make more land outside of Dubai, and that didn't really pan out. Right?
Yeah, right.
And so, again, people tend to anchor to most recent events and don't really think about, all the ingredients and things that go into historical happenings, right? So, 07 and 08, and obviously the lead up to 07, 08, again, a bit anomalous in American history, in that you had a tremendous amount of excessive building activity leading up to that crash. And it's funny because you're seeing it. I mean, not funny. It's actually tragic, but
right.
It's the old Greek
funny
tragedy and comedy are the same word, right?
Yeah.
But so, China right now is dealing with completely underreported in a large way, but they're having a massive, massive property detonation. They've had a huge speculative. The average Chinese citizen can't really invest in their stock market,
right?
And so a lot of people have been investing in very speculative real estate. No one lives in these homes. They're not homes; they're apartment buildings. No one lives in them, and you have 3 generations of families piling their money into this real estate sector,
right?
To save up to buy this investment, and that's the only thing they can really invest in to a large extent. And well, the whole thing's kind of a big Ponzi scheme,
right?
And it's imploded. I mean, they've defaulted on their dets. It's a big deal. It's I suggest looking up Evergrande. It's an interesting thing. Luckily, Chinese financial markets are relatively isolated from the global, financial markets.
What is that people can look up?
Evergrande.
Evergrande.
But so it's interesting because that's happening in China as we speak, and that's a lot like what happened here in 07 and 08. You had a ton of speculative. I mean, we've all seen The Big Short. If you haven't seen it,
right?
Great movie.
Big Short, yeah, starring Steve Carell, Ryan Gosling. What's his face is in
Brad
it too?
Pitt's in it.
Brad Pitt's in it. Christian Bale's
Bale,
Bale's in it. Yeah.
Star-studded. Great
yeah,
cast.
great cast. But yeah, it's a very kind of cool story and insight into how basically they figured out that it was going to crash, and it's like literally a peanut, of people knew this happening, and it kind of correlates to what we can get into next, which is how the housing thing kind of failed and issuing
some of the nuances as to why things are different.
Right,
now,
yeah.
I mean,
but this is a great kind of peek in, and they do a cool thing, and then we can be done talking about it, but they do a cool thing because of how kind of complicated the topic is. They do these cutaways and break them down. So one of them is Margot Robbie in a bathtub.
It's a great cutaway.
Yeah, great cutaway. Explaining credit default swaps. Is that what she's explaining?
If I recall,
yeah,
I
it's credit default
So.
swaps, which you just want to also just layman's terms, a credit default swap.
Well, and I think before you get into credit default swaps, and I think really more apropos to what we're dealing with now is, especially with interest rates, is how mortgages work. I mean, really what funds the mortgage industry, right? So, the person that writes your loan outside of, jumbo loans, portfolio products, things are a little bit, a little bit more nuanced. But for 90% of loans that are done in America,
right,
that loan winds up in a bond, a mortgage-backed security that gets sold to what we call the secondary market, the bond market, and in turn that gets bundled into other bond products, and it's in the ether, right? And ultimately it's bought by pension funds. It's, in the case of the last 18 months, probably not a wise choice. It was bought by the Federal Reserve, stepped in to buy trillions of dollars of them,
right?
And which suppressed interest rates over the last year while inflation was climbing, which may not have been a.
But also, let's not forget the reason why pension funds, all these people are purchasing these things is because it is deemed the least riskiest, one of the least riskiest things you could really set money into,
with one exception. Right, because ultimately the general thought is, and it's funny because you've got U.S. Treasuries, right? That's the most conservative bond, even though we don't pay our bills, right? And the American government, our debt picture is terrifying. At the end of the day, like I said, we're the cleanest dirty shirt. We're better than anyone else.
Yeah.
So it is what it is. But then mortgage-backed securities are considered to be a very close second, right? Because people pay their mortgages, and historically speaking, that's always been the case.
And you'll hear this in The Big Short when you're watching it. Is that's literally what they just keep going back to? Is like no one just doesn't pay their mortgage, right?
And so what happened in us. Well, so anyway, what a mortgage-backed security is it's just a whole bunch of mortgages all bundled up.
Right.
And so, what a credit default swap was, and now we're getting.
I just want to clarifying.
It's a little esoteric, but so essentially, what a credit default swap is, it's an insurance policy against the default on a bond. So, a bond, it's a 30-year bond. So over 30 years, it has a coupon rate of 5%. You buy it for $1,000, par.
Right.
And you're going to get $50 a year for 30 years. That's a bond.
That's literally how it works.
That's how it works. And so if that bond defaults, or if it looks like the bond's going to default and there's default risk, then that bond loses value. Okay. So maybe that $1,000 bond is now $500. And, what a credit default swap does is essentially, once that bond defaults, you get paid out a premium, or you get paid out like an insurance claim.
Right.
Your house catches on fire. So essentially, what a credit default swap did, and how those guys, Michael Berry and a bunch of those guys made a lot of money, is that they ultimately were, and they say this in the movie, they were buying insurance policies without owning a burning house. They got paid when a burning house burned down.
Right.
It's already on fire. They just bought the insurance. Everyone thought they were idiots. Those credit default swaps. AIG was, notoriously issued a tremendous number of them.
Yeah.
They had completely underestimated the risk of the underlying securities that were being insured.
Right.
And that's how they did really well. But I think that, and again, watching that movie, I think would be great for context. The book is even better, of course.
Right.
It's, how that always goes. But, I think it's a really good place to kind of talk about where we are now and a lot of the frustrations, I think, for people in our industry, certainly people in real estate, are running into right now is this kind of anchoring to, hey, this is what happens every time we run into this.
And I think people, when they're scared, they, instead of taking action, are just like, I'll just do nothing because I'm sure that if I don't do anything, there's no risk at all. And I think that's what we were talking about when we were talking about time horizons, things like that. It's like really aligning yourself, to like what's best for you. And it very well could be not just sitting with your hands in your lap doing nothing, right? It's like reading something, listening to something in order to educate yourself on, hey, what can I be doing so that I
very rational,
right,
as a species. Like, we're not always great at that. But so again, going back to 07, 08, 05, 06, right, the lead up to 07, 08, you had a Fed that was pretty accommodative, right? You also had the complete divorce of common sense in the mortgage industry. I was in college getting an economics degree when all this happened, so don't blame me. I had nothing to do with it. Okay,
it's not my fault.
Not my fault. But you had a total lack of fiscal responsibility, a lack of a fiduciary breach of their shareholders. I mean, just a lot of really awful behavior in the mortgage industry and in banking in general. And there's a lot of sides to it that we don't need to get into. But ultimately, banks were not incorrect in the perception that they could literally write whatever loan they felt like they wanted to, and offload all of the risk to ultimately the taxpayer, which is what happened, and in turn just make obscene profits. Sooner or later, I think some of them, one of the things from that book is like either they were crooks or they were fools, and I don't know what the answer is, but sooner or later, someone was going to get left holding the bag, losing the what's that game? You run around in a circle.
Monopoly?
No. There's a circle and there's chairs.
Musical chairs.
That's the one.
Musical chairs.
He's got it.
Someone's going to left hold. The ever-loving game of musical chairs.
Someone's going to lose the musical chairs game.
Yeah, right.
But so anyway, that's you had ninja loans, liar loans,
right?
Just a completely garbage loans that were made out there. People did not afford them. Could not afford these houses they were buying.
Right. So Ninja, for context, was no income, no job application, no job something.
I can't remember what the A.
Yeah.
No income. Again, I wasn't doing them.
But literally, that's what they were calling them, ninjas, because again, people pay their mortgage, they pay for the roof over their head. But with a ninja, you're buying a home that you couldn't even afford in the first place, and then after a certain time, I don't know if I'm mixing the two between an adjustable rate mortgage. At a certain point, the rate would adjust, and then you really couldn't afford your home, and you owed more on your house than it was ever really worth.
So those are actually particularly interesting, and we'll move on from this. We can get in these forever, but there were these mortgages. There was Pick a Pay was one of them, and
good.
Essentially, Pick a Pay, And you had options. Okay, you could either pay interest only, you could pay an amortizing payment. Okay, that covered your 30-year mortgage, and you could have negatively amortized payments. So in other words, and you can only do this for like the first 3 years, first 5 years, something like that. But in other words, essentially you paid less than the interest that was due on the mortgage, and all of the interest that you weren't paying was added to the principal. So your mortgage was literally increasing in principal every single month. And so after X number of years, and it's 3 or 5, I don't recall, but after X number of years, boom, hey, guess what? Now you have a new mortgage payment, and it's the 30-year amortized payment. The rate's astronomical, relatively speaking, and here you go.
And guess what? Remember how you couldn't afford it the first time? No, you still can't afford it now.
And so, 2007, 2008, that's when all these loans hit that maturity date, essentially, and boom, right? And so at the time, there was such perception that, hey, we're going to be able to buy this house, we're going to make more money in 5 years, or we're going to be able to flip the house. And that's really what was going on, is you had a lot of people going, I'm going to be able to flip this house, I'm going to be able to sell it so quickly that it's better for me to pay less, because at the end of the day, I'm not going to live in this house. And some people were doing that, and were doing it successfully, but the whole thing ended up facilitating builders going just completely bananas over building, and so you had this tremendous inventory influx, with no one living in these homes. So now, fast forward 15 years later, what's happened, The pendulum from lending guidelines and corporate governance and all these other things. Not that corporate governance is entirely clean, but lending guidelines are brutal, man. And I can tell you, anybody that's gotten a mortgage since 2009 will tell you, it's pulling teeth sometimes. Especially if your income is not very vanilla.
Which is like a W-2, salaried employee.
But even if you're W-2'd, right? I mean, if you're W-2'd and you're part-time, or you work odd on-off hours, and if it's not 40 hours a week, straightforward, it's tough, and for years, it's very, very, very hard to get a mortgage, relatively speaking, now than it was before. I mean, I think down payment requirements now are a lot more lax than when mortgages were the hardest in history. Back, you used to need 50% down back in the way back when, But ultimately, at least from an income standpoint, these people have jobs to afford these homes, and barring mortgage fraud, which.
But the cause of the price increase and this bonanza and that's getting everybody worried is it's not propped up on that it's a bubble. It's just that there's no inventory. So you bought your house, you love your house, you're not willing to sell your house. You're willing to sell your house for like a pretty high price, and that's what's happening. Is like when you do go to sell your house, there's like 50 people willing to buy it, and they're like, it just becomes a bidding war. And I think people don't, which is crazy to me. I'm like, people don't understand that. I'm like, well, when you bought your house, because you might have bought it at a certain time. Yeah, it was probably the only offer, and it was like, take this or whatever. You didn't have a pot to piss in, essentially. Now, everyone's looking to move and relocate and whatever the situation is, but there's nowhere to go.
Especially here in Florida, you really have really compounding issues here in Florida, all hitting us all at once. And why is there no inventory? Okay, so pendulum swung completely the other way in 2009. The banks, if you were a builder and you weren't a large, publicly traded, with a tremendous amount of capital, you were fully self-funded, you could issue bonds out to the market, I mean, unless you were one of those builders, if you walked into a bank and said, hey, I need $4.5 million to buy 20 acres and do some site work and all this other stuff, they would have laughed you out the door. And that's really the case up until very recent. I mean, still mostly the case, unless you're a very, very strong builder with a tremendous track record, very portfolio, solid balance sheet, capital in the building industry, it's just been undercapitalized for 15 years. So we haven't been building homes. Population's grown.
I think they said that too. We're about short like 4 million homes or something in America.
And you've got the children of the baby boomers. That's the second half of the millennial generation are entering the prime housing home formation years, household formation years. And so you've got I think the number was Tom Ferry said was 10 million people. over the next handful of years that are going to be entering the home market.
Right.
And we haven't built 10 million homes.
No, and I
exist.
think to even jump back to and reference Tom Ferry, he even said that normally I think we carry about like anywhere from 700, 800, maybe 900 listings from prior months in a normal traditional real estate market. I think from March into April was 83 homes or something like ludicrous.
Well, and I think the other data point that stuck with me was at like 1.2 million on average. So with new listings and carryover from previous months,
Right.
1.2 million is the average number of homes that are generally for sale in America.
Right.
And that right now in America, there's like 350,000. Right. I mean, so there's just no inventory.
Right. That's essentially what you're saying is short 1 million homes.
Right. A lot of homes, and that's right, recurring,
compounding, right?
That's every single month. And so add to that work from home. Florida has its virtues, clearly from a lifestyle standpoint, a taxation standpoint, et cetera. We've been a huge recipient of immigrants from other parts of the country. It's a mass net.
I would say immigrants, to clarify, immigrants from within the country, like immigrants being like people from New York, New Jersey, California, people moving here. They're just
the definition applies either way. Yeah.
Right. But I just didn't want it to be convoluted that we were talking like that's just
We have plenty of those too.
Florida's as well, but right. I think back to what the essence you're saying is that we have a lot of people moving here.
A tremendous influx of population growth.
Yeah, here in an area that so far is definitely not built for that right now. I mean, that's literally all people talk about.
And Florida housing in particular was hit exceptionally hard in 07, 08 because, I mean, think about North Florida. Think about Palm Coast.
Right.
There's not a job market. There's no industry.
Right. What's there? Right.
There's no industry. In
retirement, vacation. Yeah.
You have the medical sector to support the local population. You have finance industry folks. I mean, that's what I was doing in St. Augustine. That's how I landed there. Right. You did not have industry. Jacksonville has industry for sure, and it certainly is a big military town. But there was not a job market to support all of the homes that were built in Palm Coast. They were highly speculatively built. And so Palm Coast in particular took a bath in 07 and 08. And so many builders went out of business, left the industry altogether. You lost all these talented, lifetime of experience tradesmen, drywall, framers, electricians, plumbers, etc. They didn't come back. They don't just show up.
You can't just snap your fingers and be like, hey, be an experienced tradesman. Yeah.
And so, we're operating really off of, I mean, with the exception of kind of, think Nocatee, Palencia. I mean, but even Palencia is a little bit kind of pre that. But like Nocatee's newer. I mean, obviously there's some stuff, that's going to be newer, kind of west of US 1 and 95. But, for the most part, we're operating with the inventory we've had for a generation.
Yeah.
Almost.
Almost.
It's kind of crazy. So, that's really, again, all just compounding into a situation where, despite rates going up, which we can talk about in a minute, despite inflation, despite fears of a recession and some of these things that are kind of we're encountering, again, it didn't feel like a recession last quarter, despite the fact that it was,
technically
one half of a recession. The housing market here, it's supply and demand. It's the first thing you learn in economics. It's a very powerful thing.
Right. When there are no houses, the cost per house will go up across the board.
Now, if you add 40% to the monetary supply, that's certainly going to facilitate the expansion of prices.
Which again, let's just jump into that super quick. So that's already going to make the costs go up just right off the bat. Yeah. Now we're adding to the fact that we are literally we've sold off the homes that were available to move in. Now they don't exist. I mean, we have agents. We don't have agents, but there are agents, and I said this on a different podcast, straight up door knocking on homes and communities, asking if people are just interested in selling, if they've even had an inkling or thought about it, just because they have people who want to buy homes, but the homes, they don't exist.
And the common refrain you hear, I mean, at my house, it's worth a tremendous amount more than I paid for it.
Right.
What am I going to do?
Okay. You sell it, you cash in on it. Where are you going to go?
Okay. Which kind of brings us to, I mean, again, it's a really challenging supply and demand environment. There's a lot of concerns about, and a very common objection I hear, and this is really kind of why I wanted to kind of have this discussion today. We've obviously bounced around a lot of different topics, but where we really find ourselves now in this market is I've got a lot of buyers, particularly local buyers, who, they're feeling the hurt of the rental market. And the dynamics of the rental market, look, if you own a home and it's worth twice what you paid for it, and you see all the other landlords are charging X amount of dollars, you're either going to sell your house, in which case whoever bought it paid twice as much.
Right.
Or you're just going to increase the rents because you can.
And again, so if they bought it, paid twice as much, then it's going to cost more to still live there, because no way someone's going to buy it for twice its worth and be like, oh, your rent was this?
Right.
That's fine. I'll cover the other half of the rent.
And if interest rates are going up and they're
Right.
financing that purchase, well, that's even further going to exacerbate it, right? Because now their return on investment, which has to factor in the capital cost of that house, that return on investment necessitates higher rents.
Right.
So we've got this perfect storm where there's, for every home that goes on the rental market, there are 1,000 applications to move into it, because there's 1,000 new people here every day.
Right.
And that literally is the number for Florida. I mean, it's like
1,000
people a day are moving to Florida.
That's wild. But it goes back to, because people, and let's quickly try and jump into it, because we've bounced around. I want to get kind of streamlined. Is we have people moving here who can move here because they now work from home. That's just what it is. They can work from home. It is what it is. So why, when people move here and they're making $200,000, $300,000, but their job is to work from home because of whatever their job is, doesn't require an on-site thing, they can afford to either outbid you on rent and pay a higher rent, or just afford a higher rent place, or outbid you on the home that you thought you were going to buy.
Right.
So we're kind of seeing this weird...
It's a huge demographic shift in the population. When I moved to St. Augustine, it was a quiet, sleepy little tourist town. I paid, I don't want to say what I paid for my house.
Yeah,
it was a different economy. And now, these people that are moving here, that are doing what it takes to win offers right now, unfortunately, or fortunately for them, it's all relative. Their definition of affordability is completely different from the definition of people that live here. And so, eventually wages here will have to catch up, because it always has to, right? I mean, if people cannot afford to live here, that do the jobs that are necessary for everyone else to live here, well, then clearly sooner or later that's going to reach some degree of equilibrium. The problem just is what happens to those people in the meantime, and so one of the common issues, and again, this is kind of where I really wanted to have this discussion, all the time we're hearing, oh, well, we're going to go into a recession and prices are going to go down. Oh, well, rates are going up, so prices are going to go down. Oh, well, my rent is $1,200 a month. I can't afford $1,300 a month for a mortgage, but I also can only live in these parts of town, right? Or, oh, I've got a growing family and I need a bigger house, but this house isn't like Instagram pretty. It's not perfect. Right. It's like, well, you make X number of dollars a year.
This is the house you can afford.
That's the for all of those people, things are not going to get easier here.
Right.
They're not going to get easier. No one can snap their fingers and build the hundreds of thousands of houses
that we need
need throughout this total market, right? It's not going to happen quickly. And so as rates continue to climb, affordability only gets worse.
Right.
We still have an influx of people that are coming from other places for whom their definition of an affordable house is just a whole lot more than the perception has been here for long.
Right.
And so, to me, it's going to continue to be a very challenging dynamic where rents are going up, home prices are going up, rates are also going up, because inflation is not going to be something I think we find ourselves out of very quickly. And sooner or later rates will go down again.
Right. And I think the important thing too is everything we've already just basically discussed is kind of handling that, in the sense of inflation happening is not going to drive the cost of the home down. Right. We've literally just said, when inflation happens, the cost of everything goes up across the board.
Every board
always has.
Every board that's in your house, every window that's in your house,
across the board.
The value of your dollar pays for fewer everything.
Right.
Right. And so, and which is why, old school homes, real estate is excluding one time in U.S. history.
Right.
Real estate is an inflation hedge, which why are all the hedge funds buying all the real estate in North Florida?
I think
it's in the name. They're hedge funds.
Yeah, I think that's pretty important to also clarify, because I mean, it's very true. Like, if Wall Street and these funds are buying homes, that's probably because it's the safest, smartest bet, because they're using other people's dollars to make more money. So
maybe they don't want to have their money sitting in cash where it's losing value.
Right,
Maybe
but they are putting it in an asset that's appreciating in value.
Well, I would even say, and this kind of gets to our time horizons, and this is kind of where I think we finish things up. But, you know, when it comes to what the hedge funds are doing, right? I mean, so they're not going to leave money in the bank. It's losing value every day. They're not. You know, if they're worried about a recession, well, they don't necessarily want to put money in the stock market, because you're going to have volatility there for sure. You know, if you have economic contraction, a lot of those equities are going to lose value. And so what can they do that's going to generate positive cash flows with an asset that will over time appreciate in value, but in the near term generate returns that are attractive to their investors?
Bingo.
Right? And so to me, that's what I'm saying. And, you know, I think a lot of those guys all have Harvard MBAs, which outpace my, UF MBA a little bit. Yeah. But, you know, there's some smart guys trying to make a lot of money with other smart people's money, and that seems to be what they're doing. So, you know, which kind of brings us to time horizons.
Yeah, I love this, because it's what we try and tell people, and it's not a question somebody else can answer for you. It's very much an internal question you need to ask yourself, and it can't be an answer of, I might. It's like, it is or it isn't. You have to. It's a you only question.
Right. And, you know, so you're a buyer in this market. You're a buyer in this market, or you think you're a buyer in this market. Should I buy a home? Is now the right time? Time horizon. 100%. You know, are you... So hedge fund, infinite time horizon, right? It doesn't have a lifespan. It's never going to move.
Yeah.
Infinite time horizon. So what I can tell you on real estate values as we go through this economic cycle that we're, you know, inevitably going to be going through soon, you know, the extent to which things get painful is left to be seen. But, you know, will your house be worth more money next year? I don't know. No clue. No idea. Will your house be worth more money 2 years from now? Have a harder time knowing, right? 3 years, 4 years, 5 years? Probably. 10 years? Most definitely.
Right.
20 years? 100%. Right? And look at, if you bought a house in 2005, top of the market, 2009,
right.
2012, chances are it's probably getting outside of some certain areas. Chances are you probably regained
working your way back,
a lot of your value, right? You know,
but now
you've doubled your money.
Yeah,
right.
Which is, and that's the point that we're, again, in the time horizon, that if it wasn't clear before, time horizon being like, what is your 1 year, 2 year, 3 year plan? What is your 20, right? So again, let's just like quickly break it down. If you are young, you just moved to Jacksonville, you just moved to whatever city you're in, and you are setting roots. You got this great job, whatever it is. It doesn't matter what it is. Buy a house. Then you start a family. It's 3 bedrooms. Get married. You start a family. You grow into that house. That's great. Now you're about 5, 6 years in. If you have no need to leave or upgrade, it's going to continue to carry, and just that percentage. So I don't know if the overall value of the home would increase, but you'll wind up fulfilling the entire value of what you invested in, I think.
Here's the other thing. You know, you also weren't paying someone else's mortgage.
Well, yeah. I mean,
so
that's just rent across the board.
Right?
If you've ever heard this before, if you're paying rent, you are literally paying the mortgage on the property you're in. There's no way your landlord is taking a dive and is like, I am going to cover costs so that Bill and his buddies can hang out in this house. You are literally paying the mortgage. So for your excuse to say that you can't afford a mortgage is kind of a
if
jam.
You can't afford a mortgage, you know, you haven't saved up for it, you haven't prepared for this, you know, whatever the case may be. I mean, okay, that is what it is.
That's great.
But, you know, and it comes to the interest rate discussion, right? Rates are too high. I'm going to wait for rates to go down. If you're renting and you're going to be in Jacksonville for any extended period of time, and you can afford a house, you're paying 100% rent. Or I'm sorry, 100% interest on a rent. Right. You know, on a rental agreement.
100% interest.
You're paying someone else's mortgage. You're building someone else's equity in that house. You're paying 100% interest. Right?
Yeah. You get nothing. You get nothing
back,
to stay. You get to stay there.
And where rates are now, I mean, look, my first mortgage when I bought my house originally was 5.25%. And I was stoked. It was such a low rate. Unbelievable. My parents' first mortgage, when they bought the house I grew up in, that my brother now bought from them, keeping the family kind of deal.
Yeah.
17%. Stoked because they bought a house that they fell in love with. It was $150,000 in 1987, I think they bought that house. I mean, the thing's got a 1 and 6 zeros behind it now.
Right.
6 digits of some, some denomination. And so nonetheless, it's about time horizons.
Right.
Can you afford it? Can you afford a house?
Right.
Do you want to live here?
Right.
In a general sense.
Right.
Does it need to be a perfect Instagram house? No. My
Right.
house, when I first moved in, there were ticks in the carpets.
Good.
Good stuff.
Good.
I ripped the carpets out, and we had concrete floors in all the bedrooms for 10 years, 8 years, before we did a huge renovation. It's like, you know what? We know we're going to spend money into this.
Right.
I'm not going to spend half measure money.
Right. And spend money, and then in 5 years, spend money, and then 5 years, spend money.
I mean, I'm going to make this house what I want because
Perfect.
I bought for location. I wanted to live where I lived.
Right.
I could afford my house. I could afford my mortgage payment. All that good stuff.
Yeah.
Right?
Let's look right into that camera and say your exact address so everybody can show up your house.
My exact address. What's Pennsylvania Avenue?
Yeah.
But so, to me, it's there's this really big kind of lack of perspective right now where people are making some really irrational decisions, and it's not going to get easier. And so if your concern is, hey, I don't know how long I'm going to be in Jacksonville.
Right.
Maybe I'm Navy. I've got a very short-lived stint here. I know it's going to be a couple of years. Yeah, maybe it does make sense to have a conversation about, should I rent if we fall into a recession and maybe the house, maybe I find myself underwater. Now, granted, you could move and keep that house and rent it out.
Right.
So time horizon doesn't need to be short. VA is very accommodating on that.
Right. But again, that's something that it's going to go for affordability, comfortability. Yeah. Affordability, comfortability. And again, the time horizon, like if your job, and I'm going to use the word volatility, but if your job has a volatility of location, right, purchasing might not be in the cards for you. That's fine. But just know that you'll always be paying. So whether it is the fact of at some point you decide, hey, this is the cheapest real estate I'm going to find now in order for me to just get in the game, which is what everybody keeps talking about, even the crypto, NFTs. It's like, what's the bottom line entry level of getting in? You got to start somewhere.
Right.
Right. And I think just generally exploring your financing options, talking to a mortgage lender. I mean, a lot of people just comfortably try and go to a bank, but I think our other podcasts kind of address that as to why it's better to go with a mortgage company versus a bank as far as like the kind of programs or options available.
All we do is mortgages.
Right. So there's nothing really that they have to lean on heavily that's not housing, right? So I think that's a good thing to explore. Our other podcasts, it's in the reel somewhere. But I think that's what is the general tone, is that if you haven't answered whatever your plan is on your time horizon, whatever, you're always going to feel behind and always going to reassure yourself that not doing anything is the safest bet because you think that things are going to drop because they did when we had a literal worldwide pandemic. It was not just like something's happening in Ukraine, like that's why this is happening here. I'm going to wait for housing. It's like literally the world went on hold and we did whatever we could to try and get it back going. And that's why the interest rates fell as low as they did. They won't just all of a sudden just like, let's just drop them. Like it doesn't exist.
Well, and so really, why would rates drop? What are the set of circumstances that the Fed would go, okay, well, rates can drop? And again, 40% of the monetary supply from the ether is now in existence, right? So that's going to take a long time to offset that. You've got, $3 trillion in mortgage-backed securities that need to...
gonna fall. I didn't want him to fall off the back of the chair.
He's got good balance.
Hell yeah.
It's the first time we've acknowledged his existence.
Yeah. But yeah, it's cool. No big thing.
So, you've got a huge balance sheet offload that needs to happen. There's just a lot that needs to happen in order for the Fed to get to that place, right?
Right.
But you've also got all of the supply chain destruction we've done throughout every industry. Mm-hmm. All of that needs to be repaired, right? And it's going to take a lot of time. And so, unless we find ourselves in a catastrophic recession where the Fed feels like, okay, now we really need to take the foot off the gas and lower rates again. But that's I mean, that's what happened in the 70s to some extent. Is you had high inflation in the early 70s. You had an oil embargo. The Fed went, okay, well, unemployment's getting ugly, so we're going to lower rates again. And that's when they got to 14, 15% inflation.
Right.
That ended up the 70s, and then 20% interest rates in order to kill that.
Right.
So, you had a decade of inflation like this throughout the
Right.
70s and a decade of relatively high rates throughout the 70s. So
Right.
to think they're going back down to 3%,
Not happening.
I wouldn't put my money on it.
Right.
Not in the next 18 months, 2 years. 3
Well,
years.
and I think that's a good way to end it is that, hedge funds aren't putting their money on the fact that, we'll just wait for it to come down.
Now, of course, they're not borrowing.
No, but they're buying, right? And I
But they're
think,
buying.
if they're buying, that's probably a pretty clear indication that something's happening here. And again, if they keep buying, your likelihood of rent and being able to afford a house is just slowly dwindling. So you have to look internally, look at your time horizon and find out, am I buying now because I'm planning to stay here for a while, or am I trying to buy now because I'm paying somebody else's rent and I'm scrambling? It's all these things that you really need to look inward and answer yourself in order to make happen.
And to me, if your time horizon is sufficient, and you can afford it,
Right.
you should be buying a house. You should not be paying someone's rent.
Right.
Period.
Period.
If you're trying to flip a house next year,
yeah. Yeah. Not the best thing. I think DJ says that a lot. It's just not a flip market. Well, obviously, thank you again for coming on. We'll always love having you on. Follow Cross Country Mortgage. You can find Wesley, wherever. He's always in the mountains or he's scuba diving. He's doing something.
not these days.
Not these.
It's hard work these days, guys. This market is.
Yeah.
We're working.
But well, anyway, thank you, Wes. Thank you, Cross Country Mortgage. Like, subscribe, follow us at DJ&Lindsey everywhere. And real quick, back to The Big Short. This podcast is sponsored by Audible. So if you're looking to read or just listen to The Big Short, we have a link in the description below of our whatever the promo code is. It's on something for free or something for $15. I don't know what it is. Yeah, I never get it right.
I love Audible. I actually did the audio book for The Big Short.
Right.
And it's one of those where the narrator is particularly excellent.
There you go.
Really, really funny. It's good.
So check out The Big Short as well. And again, link in description for Audible. That way you can listen to it in the car and instead of reading it yourself, like the olden days. All right, thanks a lot. Later. See you, Coop.